Welcome to the Multifamily Investor Nation podcast. I'm your host, Dan Hanford. With us today, we have two guests with us. We have Chris and Ashton Levarek, and we're glad to have them here. Welcome to the podcast.
Thanks for having us, Dan. Appreciate it.
Well, we're looking into diving into this 120 unit property out of Greenville, Texas, called Summerwind Apartments. And this particular deal, when did you guys close this one?
November. It would have been November
of 2020.
Yep.
So before we dive into this, I want to go first. I guess I'll go over to Chris first, and I'll have you turn it over to Ashton and give us a little bit of a background about yourself and kind of what your focus is and really kind of where you are right now as far as the multifamily side of things.
Sure. Definitely. And thanks for having us. So my name is Chris Levarek, and I started this company, Valkere Investment Group, with my brother Ashton on the line as well, back 2018. We started in small multifamily. From our very first deal, we partnered with a private lender. So we kind of knew we were growing into this space where we wanted to scale into apartment complexes. Every deal we did, we partnered with either private lenders, private investors, other partners to acquire small multifamily. And eventually we scaled into larger deals where we find ourselves now. In 2020, early 2020, we closed a 16 unit that we went into a 84 unit in Columbus and then a 120 unit in Texas in November. And so we've been scaling at that level ever since. We've definitely changed our model. Initially, we used to wear all the hats like most people do. Small multifamily, we were doing it all. As we scaled and found people were good at different resources, we kind of niched down and started working with operators. And so now we are more of the, investor relations experience, capital raising, streamlining it, fund manager, whatever you want to call it. That's kind of where we've niched down and found our focus. Ashton, anything to add there?
Oh, that was really good. That was good. I think
Perfect.
That was a big, broad stroke of it. Yeah, that's good.
What's your background, Ashton?
So I did 21 years in the military. I still am actually, a pararescue jumper for the Air Force. And that kind of led us into real estate actually. So about 2 years ago, 2018, I'm getting ready. I'm looking at retirement, and we're looking at, am I getting a new job? What am I going to do with my career, kind of thing. And that's when Chris and I started talking about this whole real estate thing, and it just made sense. So yeah, we jumped in wholeheartedly, and it's been fun ever since. So now I still do the military thing on the side, part-time, because I still enjoy jumping out of planes and shooting guns and climbing mountains and stuff, and they pay for all that. So I do that part-time. And then, Chris and I have been full-time with this real estate thing. It's been a lot of fun building the team, building the network, growing the brand and the business. So it's been a blast so far. We're looking forward to what 2020 holds.
How's your back?
My back's great. Yeah. I know a lot of guys have, come out of that with back issues, neck issues. I've been fairly lucky, and honestly, I think it's been a lot to do with, I focus a lot on rehab. So I've been stay ahead of the game,
That's good. I know when I used to see patients, I don't see them anymore, but I actually had one or two jumpers that were patients of mine, and their backs were usually pretty bad. So they were in there quite often. So glad to know it's not taking too big of a toll on you at this point. So. Yeah. Well, let's go ahead and dive into this Summerwind Apartments out of Greenville, Texas. What was the purchase price on this one?
It was $9.2 million.
$9.2 million. And how much was the capital raise on it?
We raised ourselves. We raised about, it was 3.385 was the total raise, but we raised about, say, 1/3 of that.
Okay. And so let's first dive into how you found this deal.
Sure. Yeah. So a big part of what we do is partners, right? So one of our partners, actually, asset management company that we ended up partnering with on a Columbus deal, found this deal in Texas. They presented the OM to us. So we were looking at this investment summary, and they were doing the actual underwriting for this specific deal. And so they kind of handled that piece of it from the start and submitted the LOI. So we just came in as a partner on this one.
Awesome. So how did you find this partner?
Yeah, it's through networking, right? Networking. It's everything. It's all about who you know. And we had been discussing multifamily with a couple partners up in, I guess they were in New Jersey at the time. And they had a couple deals lined up. And as we developed our relationship, I think it was over 6 months, they turned around and said, hey, we got a couple deals. Would you guys want to partner on these? And we did. And so it was kind of a no-brainer for us. We were looking to scale. They had the deal flow, and then, we were going to help out with the branding and the marketing and raising the capital. So we partnered with them, and then they knew this asset management company, and that's who brought the deal to us. So
the asset management company is the one that kind of is the one that's you're partnering with. Is that correct?
We did partner with them as well. Yeah. Yep.
Okay. So when you guys when you got connected, was the deal already under contract?
No,
they were underwriting at that point. So we had been connected with this asset management company or partner, I should say, from almost, what was it? April 2020. We connected with them, and they were forming a partnership with our existing partner already at that time, this other group out of Jersey. And so we had known the group out of Jersey probably into early January. I want to say we were starting to look at forming a connection. They had followed us as we had done a 16 unit, a smaller deal. This group out of Jersey, they had seen that we could execute on like a smaller deal, and they had a little more experience. So when they had an ability to go into Columbus, they brought us in. At that point in Columbus, in May timeframe, we connected with this other asset management company that was going to be involved on a Columbus project. And that's kind of how that relationship started to form. So by the time we got to November, we were well familiar with these people. We had talked multiple business calls, had a few drinks, had a few laughs. So, yeah.
Awesome. So how many rounds of offers once you guys were connected with this group, how many rounds of offers did you go through to get it to the point of having an LOI that was accepted?
I want to say that was off market. That was an off market deal from what I understand. Yeah.
Okay.
They had a presence. See, that was the reason we went through with them, and they were doing the underwriting. They already had a connection and it had a presence there. And so they had formed that off market deal. In fact, they even got following up on that, we got a couple more offers that presented off market, and we didn't even have to, go into a first and final or something like that. Yeah. We ended up not pursuing the second deal with them, but that was how that went.
So you guys basically, you could partner up with this asset management group and started finishing up and finalizing the underwriting, submit the offer for $9.2 million on this off market deal. And they said, yes, they signed the dotted line and accepted the offer.
Well, 2020 was always tough. So the lending became the interesting part where, we had to perform due diligence. And then of course the bank lenders are trying to make sure that they're getting a performing asset. And so that was the big thing, was getting the correct trailing three as we were coming up to the close. And so the purchase price kept kind of fluctuating because we were trying to make sure that we were getting, if we were going to get a worse rate or worse lending rate because of, say, bad performance of September, that the seller was willing to work with us on that. So it did fluctuate. It ended around 9.2 though.
So what was the original offer on it?
I'm not even sure what was the original offer was. Let me see if I can find their analysis.
It was an interesting time because we actually had, when this one came up, we had 2 other ones under contract, and those 2 were in Columbus, Ohio, and we closed on the 84 unit in Columbus, Ohio. But we also had a 220 unit in Columbus, Ohio under contract as well. So a lot of these questions, I'm trying to remember exactly.
A deal merge.
Yeah. So
it was interesting enough.
It was a busy time.
The one in Columbus, see, we built a fund around this too on our end so that we would be able to move, over a space of a year. and into different multifamily as needed. But what happened was we had built a fund for a 220 unit that we were working in Columbus. That deal fell through, which we ended up moving a lot of fund investors to this Texas deal, which took off at that point. So it was kind of a merging of a deal. Yeah.
Mm-hmm. And so at what point during this entire process did you go and tour the property? Was it before you submitted the offer? Was it after you submitted the offer and was accepted, or kind of like walk me through that process?
It was after it was accepted, right, Chris? If I'm
it was after. It was July. Yeah.
Yeah.
Okay. And when you went and walked this property after it was already under contract, what were some of the things that you were looking for? Like when you're on the property walking, going through some of the units, exterior, interior, those types of things?
So obviously, we had several people from the asset management company combing through all the leases. But as far as what we were doing was, we're looking at anywhere we can add value, of course. So this property was made up of 4 different types of units. So we had studio, 1 bedroom, 1 bath, I believe. And then we had
2 bed, 1 bath. 2 bed, 2 bath.
Yeah, 2 bed, 2 bath. So there's a good mix there. But yeah, we were looking at, so they had some drainage issues because it's Texas, it's flat ground. So when there's raining, they had, some deferred maintenance.
We kind of got lucky. It was raining at the time. So
we got to see that. Yeah. I got to see the water pooling.
Water issues.
Yeah. And then I think we implemented a rub system as well on this one.
They had a existing rub system. We were just revamping it and making sure that it was adequately hitting what we needed to hit. But the thing was, they had wall AC units on the studios, and they were kind of like a lower, rent. What would they call it? Economic unit or something? Efficiency.
Yeah,
that's what it's called.
Efficiency. Yeah. That was the studio units. Yeah.
Yeah. So we were checking a lot of those things. I mean, the roof, the AC units, the exterior, those kind of things I was looking for. The drip, the drainage. There was some bulging of what looked like some bulging of
siding.
Brick. Yeah, siding. So kind of those big things. The interiors looked fine. Even the efficiency ones. And I think how many did we go into ourselves? I think we went to around 15 or so.
Yeah.
That day alone. But I mean, it was a really beneficial. They, having multiple teams there. We were one of the teams, but the asset management team, they were doing a lot of that lease paperwork the whole time while we were walking around the rain. So,
as well as hiring, they were managing the hiring of the boots on the ground because they were going to replace all the management.
So any of the due diligence items, one of the things that you mentioned, Ashton, was about the deferred maintenance. What were some of those deferred maintenance items that you noticed during this kind of on-site inspection?
So a lot of the units. So it was a 2-story. They're all 2-story buildings. Some of the decks, a lot of the decks, it was older wood. The paint was peeling. Some of it even looked. I don't know if it was just the angle, but it looked crooked according to the building, so we wanted to fix that up. We wanted to repaint it. There was that, of course, the AC units were older units, especially the wall mounted ones or window mounted ones. What else? I think the kitchens in some of, especially the efficiency units were, I don't know, I'm not going to say they were terrible, but they definitely helped by remodeling those. Definitely helps with the rent boost there. And the water heaters as well. I think there were some older water heaters in a lot of the smaller units.
How were the parking lots, the driveways?
It was pretty good. The biggest problem was the pooling of the water. So either the gutters or the drain hasn't been cleaned in a while, or we were trying to figure out why there was so much water pooling in the parking lot. There
had been a major rehab, they called it, in 2013. So you could tell the exterior looked fairly nice, and the interior, some of the units have been redone, but it wasn't like they were in a bad state or really bad state array or a class C minus. I would say it was more like a B minus, B.
Actually, that's the property behind Chris right there. I know that listeners probably can't see it, but yeah, it has a nice pool, had a good, a small gym. There were parts of it that was actually really nice, but there was just parts that had been let go.
So what were the average effective rents on the property before you took it over?
Yeah, I mean, so there were 4 different kinds of property rents at the time. Let me see if I can find that. But the smaller units were anywhere from $450, and then the upper units were around $850. So what we were finding is that comparable properties were getting an average rent with similar style, square footage per unit. They were getting upwards of 1,100 in the area, in a 2-mile radius. And so we were seeing on average in ours, if you mixed all the units, about 827 in average rent. But again, they varied. So the studios would be down around the 450, and then the 2-bed, 2-bath would be upwards of 900, 950. So
what's the plan, the business plan on this property to be able to increase the rents?
Yep. So it's fairly straightforward. Most of the ones that we partner on are straightforward because that's what we are familiar with, we're comfortable with, which are typically we're fixing up the outside. I even have the plan right here, but new entrance signs, new marketing, new camera, security, new lighting. There's always good to put lighting along the pathways and on the outsides of the building to kind of make it look good for anyone first before you start turning over units, so that way you can get that interest. There's let's see, what else are they doing? They were fixing some of the drainage, some of the piping, so the where it's draining on from the roof. Some they're cleaning out the gutters. That's some of that kind of stuff. But then the interior, we were doing the floors, paint, new appliances, new cabinets if needed. The new cabinets were dependent on what type of unit. So some units, if they were the studio unit, some of them had been revamped already. Again, some of it was redone in 2013, a lot of it. So we were looking to hit mostly flooring, paint, some kitchen appliances if needed, and then new vanities in the bath, new blinds on every window. And what else was there? Let me think. Update any carpet if needed in the bedrooms. So we weren't doing all flooring throughout. But yeah, it was a ramp up of around 100 per, depending on the unit class. But that was the goal, was to increase. So if we were looking to exit around, let me see, around 13 million, I believe, and we acquired around 9.2. So.
And the business plan on this, what was the overall budget for interior and exterior renovations?
I think on average is around 7,000 per unit, right? That's what I'm looking at.
Yeah, something like that. It was so actually the total interior was 670,000 was the budget. Total exterior was 279,000. So overall total came to 1.1.
Okay. So roughly about $5,500 a unit on the interior, and then the remaining was on the exterior. And what's the stabilization time frame for being able to complete the renovations and getting them leased back up?
I don't think I have how much they were going to do per year. Let me see if I can find it. It might be on schedule of values. Let me see that one. I don't actually have that with me.
Okay.
Right now.
Let's talk about the marketing a little bit. What's your game plan for marketing the property? Because you mentioned that being kind of an extra level of the business plan to be able to add some additional marketing for the property.
Sure. A big part of it came down to forming a partnership with a nearby vendor. So there is a L3 communications factory just right down the street, or factory, I should say, a building, office building. So L3 Communications, integrated systems. If you haven't heard of them, I mean, they partner with the military. They also do telecom and networking and all that kind of stuff. This one is the aircraft systems and integration industry. There's about 6,500 employees there, and they're just right down the street. A lot of the existing residents are already employees of that center. So first thing we did, we established a partnership, or not a partnership. We reached out to them and let them know that we're in the neighborhood. We're revamping a lot of these units. We'd love to, start forming kind of a existing partnership whereby they could, recommend to their employees, our institution over other different competing properties. So we started doing that. Just revamping all the signs and revamping all the online ability to find the property was a big one. A lot of this is still underway, being as it's just in November, but it's just really rechanging how you can find the property online and how you can, and who is looking and who is already kind of off market, just handing work that way or handing tenants to that property. So
one of the other things that you mentioned in the due diligence was, I think both of you mentioned this, first Ashton and then Chris did, was about the RUBS system. So you said there was already a RUBS system in place and that you guys were upgrading or improving it. What were those improvements that you were making to the RUBS system?
I mean, part of it, so they did have, they had all the laundry with coin systems.
Yeah.
So part of it is changing to an electrical kind of monitored solution whereby, we can actually accurately track that and then get, a lot of the tenants are more IT guys. I mean, they're working at L3 Communications, maybe they don't carry coins. And so just simplifying that to be more easy to monitor and more, more modern, I guess, in that sense. And then, making sure we're using the right company to, I actually don't know who they're using for the RUB system, but we're branching out to ensure that that piece of the business that they are using is accurately, quantifying and finding the amount of resources that are being used for water and electrical and all that kind of thing. And how can we change that? So.
Another thing that you mentioned, I think it was Ashton that mentioned this on the deferred maintenance side, was the decks kind of being in a little bit of disrepair. What's the plan for that? Is it to just kind of sand them down and paint them again, or is there plans to demolish them and kind of put them back up, or kind of what's the game plan?
Yeah, I think we're not going to demolish all of them, but there was a few that definitely needed to be either beams replaced or floorboards replaced and then repainted. But it wasn't to the point where we needed to demolish them. No.
Okay. Yeah. And what was the occupancy of this property, the physical occupancy?
So this one was really nice. It was already at 96%. It's at 99% right now, if you can believe that, which is pretty amazing. That was one of the things that caused the deal to slow down in September. The occupancy dropped pretty significantly because there's a high lease turnover. And so that was when the lender actually came back and we had to supply, actually, I think was it October it dropped? Sorry. So September, we had to delay the closing and get actual September financing or September numbers, I should say, to show that the occupancy had come back up with the turnover. But right now it's at 99%. So
what was the economic occupancy if the physical was at 96?
Let me see. I'm going to have to find that one.
What was the delinquency on the property?
Lost the lease?
No, more like the delinquency, like the bad debt.
Bad debt. Let me see.
What percentage of residents were unable to pay or unable to evict? Mostly because of COVID, I guess.
Yeah. So we had a physical vacancy of 8% is what we put into our underwriting. The seller at the time was saying about 8 as well. So non-payment, we were looking at, 0.7% is what they were saying. Yeah.
Mm-hmm. Okay. And how is it looking right now?
I don't actually have the updated numbers right now on that. Yeah.
So the business plan on this particular property, was there a nearby property that you were able to use as a kind of a direct comp to say, hey, they already took with the plan that we're planning on doing and have already done it and kind of proven the model? Or you in the first one to kind of, in this particular submarket or whatever in Greenville, Texas, the ones to go, hey, we feel like there might be some room here for us to go. And so for us to go up. So we're going to, take that leap of faith and do those renovations and try to push the rents.
Yeah. I mean, we did our comparisons to comp properties within the 2 mile radius that were, updated. And so we did find, I think it was like residences at Bear Creek was one. But we looked at, how they had a lower, well, I should say they had a higher average square foot than us, and they were getting average rents of about 1,100 as a revamped unit. So that proved that we could, take it up to a higher level. I think they're a little higher. So that's why we were only shooting for, say, like 950 or 1,000 versus trying to hit that high market 1,100. But they had done the same thing. They had revamped a lot of the units and rebranded their kind of online presence. And so kind of made that.
It's good to know too that it was, I think it could be considered a submarket of Dallas too. It's within 30 minutes driving of Dallas too. So that, we can weigh it at some of those outlying apartment complexes as well. But within that specific city, we compared it.
What was the cap rate that you guys purchased this one at?
It was 5.6.
Right.
Let's talk a little bit about the debt on this particular deal. What kind of financing did you put on it?
This one was a agency. It was amortized 30 years, 12-year balloon. It was a 3.1% rate, 20% down.
2-year interest only too, right? Yeah.
How many years of interest only?
2 years.
2 years interest only. And did you have to put any, I'll call it a COVID reserve, any type of reserve in place?
Yes.
That time of the year, it was fluctuating, actually, if I remember right. It was like initially they wanted 12 months reserves, then it dropped to like 8 and then to 6. And that was part of the reason we went back and got better terms too with the agency bank, with the bank too. So, but yes, initially they did, but then I think it dropped down to 6. I think 6 months was the final on that one.
Yeah. Yeah.
And which agency did you go with?
Just let me see.
Yeah, the fun part about this was, a lot of these numbers you're asking are what our partners handled on that side. So,
this with Arbor Commercial Funding.
Okay, good. And how did you end up structuring the deal with investors?
So we do a straight, we call it a 6 and 6 or a 12% pref, but we do a 6% cash on cash year over year, and then match that sale to get 12% average annual return. But yeah, we just keep it straightforward, no waterfalls, no confusion, right? So 6% year over year, and then match that sale.
So you basically did a 6%. Is it a 6% pref or a 12 pref?
Well, it's a 6% pref per year, but then at sale we match another 6%. So that way, they're not going to make any less than 12% over the total 5 years. As long as when you sell it, you get over 12%. Absolutely. Yep. Okay. So it's technically a 12 pref if you think about it, because they're going to get 100% of the cash flows as well as the sale proceeds up to 12%, and then you guys to get the rest. That's correct. Right. Okay. Now, is there also a plan in place here for you to refinance it instead of selling it, being able to refinance all the investors out by doing a refinance
giving them their 12% and all their capital back, and you guys just keep the property? Or is there not enough? Well, is there not enough meat on the bone on this one to do that?
At this point, I don't think there's enough meat on the bone to do a refinance. So the plan is to sell, but yeah.
Actually, on our Columbus deal, that's what we're doing on the Columbus deal, but it's a bigger flip, meaning we're adding, there's 28 down units when we bought it. So it's definitely almost like a flip, heavy renovation. Whereas this one is more of a unit turnover, slight rent bump, exit of year 5.
Mm-hmm. Okay. Now, when you're doing the 6% during the hold period, where you're giving out 6% of the cash flows, do you do a cumulative or a non-cumulative, I guess I would say preferred return on that 6% during the hold period?
So,
Never.
I was going to say, so we're doing 6% from cash flow, 6% from end of year sale, meaning it's a 12% on all the entire deal annualized. So no. So basically, so if say someone does 100,000, we're doing 6,000 per year, and then we're matching that at end of year all together. Yeah.
Okay. Well, what I mean by the cumulative side of things and non-cumulative is, let's say the first year you can only do 4,000. Does the next year, does it add up until you actually sell? So in the end of the day, they're going to be made whole on that 6%.
Right. Yes. Right. You mean like a catch-up provision?
Well, it's not necessarily, it would be considered it's not really considered a catch-up provision when we're talking about that, because a catch-up is usually on the GP side where you do a 70-30 split, but the preferred return, they get 100% of those cash flows up to that preferred return amount. And then the GP catches up to the LPs at that point to make sure as if they were getting that same 70-30 split all along. But in this situation, I guess you could call it a catch up, but it's really more of of accumulating that preferred return to make sure that the investors still get that, even if they don't hit it 1 year.
Well, first of all, we don't do deals like that. So if it's not hitting 6%, then we won't come in with that sponsor. So it should be giving a 6% return from day one, which is why we're fine not getting that. We're fine not getting that anything over 6%, but if it's not hitting 6%, part of our model is saying it's going to hit 6% and then some. There's going to be a buffer that goes to the GPs, and that's the buffer kind of security to the investor. But let's say worst case scenario, it did go under 6% return for some reason, then we would catch up. It's a preferred return, meaning our investors get 12 at the end of the day after sale. They get that 12% before we see. Yeah.
Okay. So the way this is structured is the investors are getting up to 6% during the hold period. Anything over that, you guys are taking for your cut during the hold period. And then when you sell, then they're going to get their next 6%. And then you guys will get the rest over that.
Correct.
Yep. And if there's any point in time during the hold period where there's a year where, even though you're not projecting it, but if it does drop below the 6%, then you guys don't get paid. And then the actual LPs just get a reduced payment. But then the next year, if those payments of if the cash flows go above 6%, then the investors are made whole.
Exactly. Yep.
That's right.
Okay. And the 12% is an annualized 12%. It's not an IRR 12%.
No, it's annualized. Yeah.
Okay, good. And so how did you go about raising the capital on this one? I know you mentioned that you had a couple of partners on here that helped with the capital raise. On your side specifically, what did you guys do to be able to raise this capital?
So initially, this one was a 506B. So it was all friends and family, prior relationships, obviously. But yeah, we had been building up a network, building the brand with our business. For this one, we actually opened a fund because we were closing on a couple deals at the same time, and they followed the same deal structure and returns. So it made sense to raise in a fund, and then people get to pick which deal that their capital goes into, according to what market they liked or not. Does that make sense?
Mm-hmm. Yeah. So So even though it's a fund structure, they don't get the diversification of the multiple assets in the fund because they're picking which asset they want their money to go into.
That's right.
Yep. So on the front end, the organization side, they can pick the asset. On the back end, the bank account, the LLC is one single entity. We just like to keep that organization so that they can, if they wanted to diversify, they could go into Texas and they could go into Columbus. It's still the same fund doing the, acting as an LP in the deal, but they have the choice in our end on our portal to choose two different assets. Does that make sense?
Okay. Mm-hmm.
That's the cool thing about the fund.
Yeah. So throughout this entire process of acquiring this property, can you think of anything else, any other type of issues or problems, good or bad, that maybe came up throughout the process that might be interesting for us to talk about that we have not already talked about so far?
Yeah, I mean, go ahead, Ashton.
I think one of the things we did that was really cool with this property was at the closing of the property, I think it must have been a week or 2 weeks after, we went down to the property itself and had like an open house where a lot of tenants could come and talk to the new owners, and getting to know the tenants. So really getting a face-to-face with people, they get to address their concerns. There was food and drink, and I think it was a cool way. I'd never done that before on closing on a property, but I thought it was a really cool way to actually show them we care. And because we do, I mean, as much as they live there is as much as we're invested in it. So they're as much our, part of this, partnered in this deal as we are. So it was very important for us, to be there and show them what we're going to do, our plans, what we're going to do with the property, and get their feedback. So I thought that was a really cool thing to do. And I recommend it. I'd like to do it on every property we do it.
Yeah.
What about you, Chris?
Yeah, I mean, I'm more detailed, so I like all the information. I think clarifying up front with people, everyone who's on the deal, whoever you're working with, detailing how we're going to get information when it's needed, or working from the same playbook is very important. So if you are partnering with another sponsor, you're partnering with another property manager, asset manager, working from the same, updates, I guess, so that everybody is getting the same information on a consistent basis. Some of that was lacking as we were getting, closer to close, and it was understanding things were changing so fast with lending and what was going on. I was missing which rate, where are we at now? Week to week, it seemed to change. The reserves kept changing. So we would do underwriting 1 week, and then all of a sudden that's different in a couple of weeks. So a lot of that is something that can be worked upon with partners or whoever's listening. If you're looking to partner, working for the same playbook, having those weekly calls, having those daily calls if needed, to get on the same, the book. But, COVID was kind of an interesting year to be buying real estate. It was also one of a lot of opportunity. So if you can make it work, you can have that opportunity.
So I have two final questions, and you guys both don't have to answer this, but whoever wants to answer it can. The first question is, they're kind of contrasting questions. First one is, what did you find that was easier during this entire process that maybe originally you thought was going to be a little bit more challenging?
Developing the relationships. Well, actually the scaling. Initially, we were faced with, we knew we wanted to get into larger multifamily properties. So 2020 was a big year for us. I mean, we went from small multifamily to 100 plus units in, less than 6 months. But so defining what we wanted to get out of a deal and what kind of people we wanted to partner with to help grow our business. And I think a lot of people get caught up in it's a deal, we want to get in a deal. And so they partner with anybody, or, the projections look great, so we'll partner with them. And this kind of comes back to what Chris is talking about, is like being very clear about your deal criteria and very clear about your partnership criteria, because, you're married with these people for the next 5 years. So how are you, just because the deal looks good on paper, is that really who you want to be married with for the next, 5 years? Are they going to be, how do you know they're going to hold up their end of the deal? Partnerships can be a super powerful way to get started and a powerful way to grow your business. But you really do have to, neck down on what's important to you, what's important to your business, and then how that's going to help you push forward, as well as how you're going to help them. So that was something that we really got into there at the end of the year, was really focus on how we're going to build this business through partnering.
Yeah.
And the last question I have for you is kind of the opposite of that. What did you find that was harder during this entire process that maybe originally you thought was going to be a little bit easier?
I think, partly for me, it was communication. And, the partnership. So partly our issues in early 2020 were deal flow, and then we partnered to get deal flow. But what comes with that is, and not only that, we partnered to be able to play a specific role. And so that was really advantageous to us being able to scale. However, with that comes some issues where the more people playing a specific role, the better your communication needs to be. So if you have 3 or 4 different GPs now, each fulfilling a role, and they're not all under one company, your communication needs to be much, much stronger than if you were just playing all the roles. I could just, call up my brother really easily when we owned a property, and we settle it in a couple of minutes. But sometimes getting 3 or 4 people together throughout the week on a schedule, that could be a little difficult. So the communication piece was a little harder. Getting all that data together all at once in front of everybody all together can be a little hard sometimes. So, yeah.
Good. Well, I want to thank both of you, Chris and Ashton, for being here with us on the podcast and sharing us some different insights and golden nuggets around this acquisition form that you had back in November of 2020. How can the listeners, not the readers, about said readers, how can the listeners reach out to you if they have further questions for you about this acquisition, or maybe they want to join you on some of your future opportunities?
Sure. Yeah, our website's the easiest way, valkeregroup.com. That's VALKERE group.com. There's a contact us. You can reach out there. We have plenty of information, a blog, an ebook, all that stuff. So feel free to contact us on the website. We're also all over. We're on LinkedIn and BiggerPockets. You can reach out there as well.
Awesome. Well, again, thank you both so much for coming on, and looking forward to continuing to follow you as you continue to close more deals here in 2021, and also having you back on the podcast as you continue to close more deals.
Hey, thanks, Dan. Appreciate it.
Thanks, Dan.
All right.
Definitely appreciate it.